Thank you so much for that. Let's bring in James Demmert. He's Chief Investment Officer at Main Street Research. He's usually in the U.S. He is in Europe this week. I think he's picked the perfect spot in Europe, Florence, of all places. James, good to have you here. I hope it's beautiful and sunny in Florence as well. Let's talk about the big event in the markets this week, and that's obviously the Fed meeting, this expected 25 basis point cut. But is there a sense that the markets may be getting ahead of themselves once again as they're pricing more cuts deep into 2026? And is the Fed going to push back?
Good morning, Carolyn. I think that is the most important thing right now. The Fed will go on Wednesday. We're pretty assured they'll go 25 basis points. But, you know, the U.S. market, futures market, is pricing in 2 more cuts after that by the end of the year. And I'm not so sure the market's going to get that. So that could cause some volatility, particularly, let's say, in October when that second cut is likely or is in the futures market. I think they may pause there. Yes, the economy is, the labor market's weakening, but U.S. economic growth is quite strong. So I think they'll look at that data, and I think they're going to go slower than the market expects. Investors should be ready for that volatility.
But James, it's really interesting. You point out that the market is due for 8 to 10% correction. What exactly would trigger that? Would that be the Fed pushing back?
You know, we're bullish, but I think that investors have forgotten over the last year, or maybe not since April at least, that normal corrections occur quite often in bull markets. They're usually about an 8 to 10% drawdown, and they usually come with some disappointment by the overwhelming amount of investors. And I would suggest in the U.S. market specifically, investors are really anticipating those 3 cuts. And I think any pause is going to cause some sort of pullback in the market. It's certainly very overdue. We've had a huge rally, obviously, since the April lows. And in our view, for those investors maybe that aren't fully invested, if you do get that 8-10% pullback, you want to really pounce on that. You want to buy that dip, which would probably be somewhere in September, October, based on expectations. I'd also be careful here on Wednesday. Listening to the Fed presser, I think is going to be important. Powell might even suggest, yes, we're cutting once, but we're really unsure about the rest of the year. And that could cause volatility even this week.
James, it's really interesting to hear what strikes me as a somewhat contrarian view, because there's also a camp talking about a potential jumbo cut at the Fed meeting this week. Clearly that there is a minority who believe we could get one, but there's a possibility we could get a 3-way split here. How do you think the market reacts if we were to get a jumbo cut this week?
I don't think the market would act well to that. I think it would sort of set off a fire alarm that, wow, maybe growth is worse than expected. So I think the odds of that are low. I don't think the Fed wants to send that message. And let's remember, you know, the labor market's weak. That's why they're going to cut. Now, we're not really quite sure if the labor market's weak because of AI layoffs and immigration policy, or it's actually, right, the economy weakening. The data suggests the economy is still resilient. So I think, again, a jumbo cut, I don't think it would send a great message. I also think the odds of that are probably very low.
We've also got U.S.-China trade talks in focus this week, taking place in Madrid. How do you think about those talks from a trading market perspective?
Well, we're a global investor at Main Street. We love to invest all over the world. I would love to go back to China. But frankly speaking, it's been uninvestable for quite some time. And I love the stimulus that they're doing. These trade talks are extremely important to the China-U.S. trade policy and a lot of companies that are obviously embroiled and entangled in it. So we are optimistic, cautiously. But as we all know, these negotiations have gone on for a long time and not much has come from it. So we basically would suggest to investors maybe stay away or be very small allocation to China until we get that opened up.
James, I want to bring you and viewers a couple of fresh lines from the Treasury Secretary coming through just now. Scott Bessent saying we've made very good progress on technical details with the Chinese delegation. The Chinese have come with a very aggressive ask. We're not willing to sacrifice national security. Clearly not a huge amount of detail yet, but trying to signal that they are making progress here on technical detail. What do you think is priced in when it comes to the U.S.-China relationship? We had a guest earlier on the program who's a Chinese economist who said he thinks actually we're just going to see more kicking the can down the road because there's not a huge amount of urgency pressing Xi Jinping on the Chinese side to get a deal done. Many of China's issues that are driving the weakness in the economy there are actually homegrown domestic issues. It's not the trade policy that's the problem at this point.
Well, we would agree with that. It's not the trade policy when it comes to the Chinese economy, and that's why they're throwing everything but the kitchen sink at, trying to stimulate the economy there. Trade would be helpful, but we also believe, Besant's comments are more about, they're asking too much. That's kicking the can down the road, and it doesn't give us any sort of finite time that we might be coming to an end. So again, I want to be less allocated to China when there's so many great other opportunities around the world.
James, let's take it back to investment strategy. And what you've been pointing out is buy the dips when it comes to the European and the U.S. markets after that correction that you see in the not too distant future. Any specific stocks that you want to share with us?
Yeah, sure. I think in the U.S. market, it's a very narrow market there. It's a tech-led market with telecom and technology stocks and financials. Those are really the only sectors that are working in the U.S. market. Most of the rest of the market hasn't done a lot. And that's because that's where the best growth is. So I would suggest to investors, yes, stick with AI, technology, financials in the U.S. Now, when we go overseas, you have a tremendously different kind of a market based on fiscal spending. So there you want to go, not just to tech and financials where there's a big bull market, but you want to go very broadly because basically PE ratios are a fraction in Europe of what they are in the U.S. So in Europe, I would go to HSBC, the largest bank, Siemens Energy, which is helping us expand the electrical grid, a company like Taiwan Semi, which is playing this big AI move. And then overseas in the U.S., you want to play those Mag 7. That's what's really working. JP Morgan is another example of a financial. So sort of be very sector-centric, but I would definitely be overweighting those European overseas markets. They're fractionally way less expensive than the rest of the world, particularly the U.S.
James, before we let you go, just a final point here on how much this week the 25 basis point cut by the Fed could potentially be an inflection point for the overall market. We know that more than $7 trillion is sitting in money market funds, and you're well aware of that, of the school of thought that once we get the first rate cut by the Fed, that's going to unleash all that money, maybe not all of it, but part of it into equity markets, into bond markets. Are you a believer in that story?
Yeah, we are a believer. But I do think, what's more important about this meeting on Wednesday with the Fed is what they say, not what they do. And I think that there is way more money on the sidelines than there should be. And again, I think if you had a dip, that money's kind of come in, not just to the U.S. I think with the valuations Europe, that money's coming to Europe as well. But this could be the beginning of the easing campaign by the U.S. So be bullish. This is still the early part of the bull market, the global bull market as we view it.
James, always great to get your perspective. Enjoy Italy. Thank you so much for this. James Demmert, Chief Investment Officer at Main Street Research. And let's get back to